So hello friends, this is Rajat Dhar, Director at FINOGENT Advisory, and today we will be talking about RBI monetary policy that had happened, and we know that the rate of interest has not been changed. Now, having said that, the crucial question arrives: if the rates are not changed, which we were actually expecting in the month of September 2024 and October 2024, what it means for the Indian investor and what the Indian investor should do if he has short-term, medium-term, and the long-term goals. And also, what does this mean for retirees and those HNIs who wanted to preserve their wealth? So the objective of today's video is to ensure that as per the current RBI monetary policy stance, how every investor should do things and how every investor should actually work out on their goals based on the current RBI monetary policy review. So having said that, firstly, we will be talking about the short-term goals. And when we talk about the short-term goals, the goals which are within 2 to 3 years. So any amount that is there parked for the short term should be placed into a fixed deposits or even the short term funds. As we have seen that the short term funds have given a return of over 6.5% rate of return. So this will ensure that you should not be playing it on the yields per se. You cannot put your money into medium term or long term bond funds when you are actually looking at consuming the money in next 1.5 or 2 years. Now, even if in that matter you have a certain money where you are not quite sure whether that money will be used within a year or so, or within 2 years, you can still put it into those GSECs who are having their modified duration even less than 5 years. I would say rather 2.5 or 3 years for that matters. But the pointers to be checked are: what is the credit worthiness, what is the track record of that bond or a fund in which you are actually investing into. So these are a couple of things that you need to be working on. Second thing comes upon the medium term investors. So when those who come for the medium terms, they know that okay, we have a benchmark which is called as the 5 years GSEC yield, and that itself has given around 7.1% return for that matter. HNIs can also go for a tax-free bonds for that matter, but everything else keeping in mind, you need to know how the RBI is actually going to work their way up. But that also would depend much more upon the Fed rate hike policy. If the Fed rate hike policy is there and quite steep, then the RBI might also be stretched into extending the rate hike and not cutting it. So you need to see whether they are accommodative or not. So that is the catch. For those clients who are looking at the long-term wealth creation, long-term bonds, and you have an urge to go for the long-term funds like gilt or GSECs, more than 8 years, 9 years, constant maturity funds, you can do that, but you cannot be too much, you can say, time the market. You cannot time it. But yes, your fund deployment should be in sync with your asset allocation. That should be in sync with the need of the money at a prescribed time for a prescribed financial goal for that matter. But if you think that okay, maybe in the month of November or December the RBI will start cutting the rate of return and therefore rate of interest, and say therefore I should put in the money in bulk into a certain in that case, if you are actually timing and you are working like a trader for that matter, then I think you should first wait for RBI to take first step and then you should do it. If you're an investor and if you are not too much into timing the market and you have a corpus, then a part of the corpus you can start thinking about deploying over a longer period of time in the coming quarter. And so this is how we are actually looking at. As far as retirees and wealth preservers are going, the first paramount factor that you need to understand is that the safety of the capital has to be the first. The safety of the capital first means that you cannot go into a bond or a fund just because it is giving you 9 or 10 or 12% rate of return and it is a double A minus for that matter. So therefore, just because you're getting higher rate of return doesn't mean that fund is good. So you can go for a longer dated bonds, which are backed maybe by sovereign or maybe the government or maybe by the bigger PSUs who have backing and who have the credibility into the market, and then go for it. So you need to be updated not only about the market but also about the creditors. Say for example, we know that there have been things going about Vedanta for that matter. So if you're thinking about, say, similarly many corporates come up with their bonds which are double A or a double A minus or a single A minus, providing to 9.5, 10%, and then it is a cautious call for each one of us to get into. But having said that, based on RBI policy review, the rate of interest in India are the all-time high. So therefore, it makes us a prudent time, a very good time for us to at least have being able to take much benefits of this medium to long term scenario and have some eggs into the right perspective, because the risk reward ratio of getting into the equities is too steep at this point in time. Because at this point where we know that even many of the large caps and the mid caps are too much higher on PE, they are too much costly, which doesn't make any logic of getting into those stocks. So unless and until you are not getting into cyclical stocks which are at the 52-week low but can be expected upside, unless until there is no straight rationale for it, we don't recommend anyone for that matter to going into it. Because unless and until any investment philosophy, whether that goes with bonds or equities, if it is in sync with your risk appetite, your asset allocation, your expectation of the returns, your financial goals for that matter, is not worth the time, energy, and the worry that you will be putting at the back of it. So this is Rajat Dhar signing off as of now. So happy investing. Thank you so much.